Equity. Anybody want to tell me what that means? And to make it a little easier, just let's stay within the focus of this conversations today. Ownership. Anything else? Balance. Great. Access, yes. Sharing something. That's great. High risk. Great. This is great. These are expanded beyond what I was hoping for, but the big thing is there's sort of two general buckets that I look at. Is there's a sort of injustice aspects of the world, and then there's the investment vehicle. But we're all dealing with it in impact investing. Here's a term. I dealt with this actually a few years ago in a meeting when I was organizing a bunch of foundations at the beginning with my peers saying, who's interested in using market-based strategies to grow the regional food economy? And when people came in from the Bay Area and some other parts of the country, from the foundation world, we sat into a meeting actually in this building with individual investors and started talking. And one of the nonprofit fund managers were talking about technical assistance and using that in their deployment of capital and so forth. And one of the individual investors who came from the hedge fund world said, time out. I have no idea what you mean by these words. And I'm thinking, okay, knowing Norm, he comes from that world, we mean business development. He's like, well, why don't you just use those words? Well, because in the nonprofit world, that's, oh, wait, we're using the same words with different meanings. How about this one? I think we got a whole conference on this one. And that's a critical aspect here because there's a lot of capital trying to play in similar veins, using different words and logics, and we're trying to achieve different outcomes. How do we line that up? So, my name's Tim Crosby. I'm a participant as a funder and investor. Funder is a term that philanthropy uses for donations and grants, but I also invest capital, and I'm coordinating the development of a network of foundations that are also interested in trying to figure out how do we finance in this space. We've been going for about 3 or 4 years, but we've not been visible, really. We've been trying to learn as we go. So we've been doing a lot of pivots and learning as we go. We started with the idea of, well, let's just pull our money together and get it out in the street. But when you pull together private foundations, corporate foundations, community foundations, and some individual investors, that's a mess up front. But we did recognize that we didn't want to just fund, say, nothing against kale chips, but the next kale chip manufacturer. We didn't want to be transactional. We tried that at the beginning. We weren't getting what we thought, and we realized, well, wait, we want to be really strategic. We want to understand what grows well in Pacific Northwest, Washington and Oregon. What are the sustainable production models that are actually in use? What are the market drivers? What are the investment opportunities? Is there a need for a fund? We don't want to go set up a $20 million fund that we can't deploy. So what was serendipitous, and this is really interesting, and just being aware as you move forward in uncharted space, looking up a lot to see what pops up. And one of the things that popped up was EcoTrust was finishing a report just about the same time down in Oregon called the Oregon Infrastructure Gap Analysis. And they were really looking at just that. Where's their infrastructure that's missing for our production in Oregon? We found that relevant to Washington, and one of the interesting aspects that they were coming out with was that there is a huge gap for these mid-scale producers that are wholesale. They're not necessarily the small direct farmer market farmers and CSA, but they're not the commodity growers. Yet they're having to compete with them. The infrastructure for them is missing. And this is a graph, hopefully it can be seen pretty good, that just shows all of the chicken, beef, pork, grains, greens, and storage crops where they're focused, and all of the different businesses and value adds that go all the way between farm and fork. And so they started help breaking it down. But what was interesting is they did a production cost analysis just as a case study, because they had a farmer say, this is great, but I just want to know why my product is more expensive when it hits the loading dock. So what we did is we blew up that production case and looked across all 6 categories. So we looked at not just chicken, but we looked at what production models working here. Pastured poultry, grass-fed beef, hoop house pork, wheat and small grains, organic storage crops, which are potatoes, carrots, and onions, and also leafy greens. And we look, because those are being used here, what are the investment opportunities, and go. We learned a lot about the production models and the opportunities in between all of those categories. I'd be glad to talk about that more. I want to focus on the unintended learning. What we ended up doing is, as we were going forward with this work, we started testing out this research that was a sort of new type of research, but combining with nonprofit knowledge, and then also towards trying to get it in front of investors, and realized we were getting feedback that it wasn't quite making sense with the investors. So in the end, what we did is, we had our 400 pages of research. We asked a nonprofit to give us an analysis, just give us a ranking. Where are their opportunities, high, mid, low? And we asked the same of a professional lender, and their recommendations didn't match. And we thought that was pretty interesting. Very exciting meeting that all of us who were there will never forget. But after they left, we sat back and said, okay, what just happened? And actually, it was someone from EcoTrust. I'm not sure if Nathan's in the room right now. Nathan Kadish said, "Look, I'm in a nonprofit. I deal with nonprofits all the time. They're after system change. But as the investor working with EcoTrust Natural Capital Fund, I deal with these for-profit guys all the day, every day, and they're there to pick winners. So you have the nonprofits that are working in this space that are dealing with system transformation." And you have the for-profit investors who are looking at enterprise-level successes. All right. And so that helped us understand why the recommendations didn't match. Luckily for us, wheat and small grains is the only one at the top that shows an opportunity. And I'd be glad to talk about gains and about in that space that we're seeing, and we already see others playing in that space. But I want to just stop and see if what I'm saying makes sense to everybody. Does this make sense? Was it knowledgeable? I mean, some of this stuff is like, well, this is pretty obvious. But sometimes you got to state the obvious because it isn't. But does this help with some of the work you're doing? What's interesting is that with the CFFP work, we've been going for about 4 years, heading into our 5th year now. This is the first time that we've had the investors, the individual investors in the foundation saying yes to the same thing. And what's interesting also is as we talk with foundations, have them go, you just described our program office team on this side and the investment team on the other side. So it's not just investors and foundations, it's together. Did you have a question? Sure. The question is, what does a nonprofit high opportunity look like and a for-profit high opportunity look like? So let me look at wheat and small grains. Yes, we're lucky that they're in there both. For the nonprofit, it's not just about the wheat. It's about you can build soil health. You can do carbon sequestration with the right practices. In this case, it's no-till. No-till means you don't turn the dirt over every time. You let the soil help you. And you're building nutrients, and you're also helping create an opportunity for water preservation. Some of these, if you have blank soil, water goes through. In drought conditions with healthy soil, the water sticks around. You don't need as much water. But you're also sequestering carbon, and that's really opening up as a critical aspect. For the for-profit, it's that there's a huge demand, just flat and simple. The demand across all of these products outstrips supply. So, but from a traditional due diligence or underwriting framework, like this just makes sense. The businesses that are trying to get into this market or grow in this market have a high demand aspect. And we know that the no-till production model that is used in Eastern Washington and Oregon actually is competitive with conventional because they're not having to do as much work to the land. So just pure and simple, the costs are lower. So let me just dive a little deeper. What we've done also is we've looked at this a bit more. And we've looked to say, not just are we after system change or enterprise success, but what are we trying to do? Well, we're trying to change a system. We're trying to invest in a particular enterprise. Yes. We are deploying grants as foundations or nonprofits, or using non-grant capital to grow our nonprofit, but we're not trying to make money back. But the for-profit investors are after all capital preservation strategies. Otherwise, going below zero is just stupid. I've heard that. But the other interesting one is risk. If you start looking at risk from an aspect of take a financial lens and look at nonprofits, is that foundations and nonprofits are a hotbed of prototyping and research and development. They're trying things out. They're not trying to make money. They're trying to develop new methods that can hopefully play out and in the nonprofit language, replicate. In the for-profit language, scale. But it's a really interesting position if you start trying to position grants and concessionary loans. Here's another word, PRIs. Who knows the term PRI? Good. Tell you everybody, not even half the audience. That is a tool that's been around in the foundation world for decades. It's called program-related investments. So they're investments out of the grant side of a foundation, but it's at a concessionary rate, 0.5% to 2%, or maybe something like that. What investor wants to invest at 2%? Not many individuals, not a lot of impact investors, but foundations are doing this all the time. And it's really gaining traction with this bigger term, impact investing, really opening up and covering not just foundations and individual investors or for-profit investors, but help to bridge foundations and their two sides of the house. Those that make the money on the for-profit side and the investment teams, and those that give it away, the grant teams and the program officer teams. So now again, looking up at what was going on, we found out that this comes back to your question, ma'am, is that how are we looking to align items? This is a graph that comes from actually a Tonic Institute report funded by Shell Foundation at a international level. And it's really simple. The y-axis is impact return and the x-axis is finance return. On this type of graph, you see that grants are pretty much negative 100% loss every time. Any impact investment is above zero. There's a little gap between minus 100 and zero. There's lots of opportunity to deploy and engage in different types of capital, especially it gets competitive when you get above zero. So the big question, the big opportunity space is how do we fill that gap? What's interesting is seeing some foundations stepping forward and saying, well, how do we move from minus 100 to minus 50? How do we do that? Let's figure that out. What I've seen one foundation do just at a meeting in this building about 2 months ago is they've already figured this out. They've taken this and they've just made two buckets. This whole side is their charitable work and this side is their investment work. So there's innovation beginning to happen. It's a matter of, who's willing to try. There's different terms here. Strategic loss is a term that would be more from a financing side, which is I'm willing to lose money if I open up the market. That sounds like a grant, where you're not willing to make money, you're trying to transform a system. So this is the rich space to work in that we're working on now. What are we doing with this effort? Well, we realize that actually we have some precious capital inside philanthropy. For me, there are three: grants, PRIs, they're pretty unique to foundations, and the third is convening, just bringing players together. Someone's got to fund it. How do we bring the players together? And from a mission-oriented standpoint, you bring together the people that are doing work you want to succeed. They can be banks, CDFIs, investors, everybody. If you ever seen like the Valley of Death graphs, most of that money is after it's taken off, after it's scaling and succeeding, and what you're doing is creating, every success yields maybe another round and bigger money. That's where that money plays. From the bond perspective particularly, what's really fascinating is there's a trade association called the Council of Development Finance Agencies that's made up of memberships from CDFIs. Okay, there's another term. Who knows what a CDFI is? Less. Council of Community Development Finance Institutes. They're regulated like banks, but they're geared towards community development and take higher risk. Craft 3 is in the room. I'm sure there's a few others, or maybe they're in another room, but they're here. They work in Washington and Oregon, and they work on social missions and lending. They take earlier risk than banks. So CDFA is made up of CDFIs, economic development authorities, housing finance commissions, those sort of quasi-governments. They help create clean energy bonds that are out there now in the marketplace. It took about 7 years. They're now focusing on food system bonds. They're trying to figure that out themselves. So those are the right players to engage. Where do they play? Right now over here. But they understand this. So this is a really interesting time right now for that. Anybody else have any questions about this? Is this making sense? That's my main goal, understanding this gap. I don't have perfect solutions about how to fix it, but that's what we're all here to figure out. So one thing that we're looking at is, well, we're looking at two things. I started mentioning Craft 3. We as foundations recognize that we could deploy some of our precious capital, grant capital, to help test out the real demand for a large fund. Craft 3 has 6, 7, 8 offices across Washington and Oregon. And how about if we build up their lending infrastructure for a period and see what's out there? It'll save us all the aspects of raising $20 million or so forth without being able to deploy it. So this is a really great time that we're working on that right now. And come see me later if you'd like to find out more about that. It also creates sort of aspirational aspects that get through that big graph. From the idea that nonprofits are after system change and for-profits are after enterprise success, maybe we can look at how do we transform strategic value chains through individual investments. So what I've tried to highlight here is the grain infrastructure that goes through this chart. And what type of investments are needed? Well, there's all sorts. Transition is get farmers off conventional to new models. That takes research, that takes maybe some cash flow analysis that could be grant funded to show that this is how you made money, but this is how you can make money. Infrastructure, silos, milling, malting. There's some wonderful stuff going on in Skagit County. I talked with a group of farmers in eastern Washington, Shepherd's Grain. They were trying to raise a round to do their own huge mill, and they recognized, well, wait, first, we need silos, and it's very simple when you think about it. We're trying to do identity preserved product. We can't stick it in the same silo as the commodity. There's a cash flow, there's a business model for it. You just need the infrastructure, you need the lending and the money to place them into places. Working capital, lines of credit, everybody needs that. Rotational crops. This is what happens for those not deep in ag. When you plant something that takes up nutrients, you want to put another crop that brings in those nutrients later. And those rotate and they feed each other well. Soybean and corn were in real good balance between the two. That's why they both took off. It's gotten a little out of balance as you really get corn subsidies going. But that's the basic idea of rotational crops. These rotational crops are barley, oats, and chickpeas and some things like that that actually have markets. How do we help them build up the right infrastructure, and how do we help them get to that point so that they can make money on the so-called off-season? That gets into marketing. Maybe there's some grant money that just helps push this out there to everybody to understand how to use these products. And the consumer, of course, just drives things. If they're asking, so this is consumer education campaigns, there'll be more demand for that product. Okay, so I'm going to stop there and just make sure, have I confused anybody? One? Okay, well, please, what's not making sense? Yeah, good. I don't want to pick on anybody, but let me ask the other side. Does this make sense? Yes? Was it visible before I started talking about 15 minutes ago? That's the interesting thing. So this is what, back to for me, for the power of philanthropy, is we've done research, we put in money. We want to share it to everybody, especially those who are trying to figure out how to invest, how to form partnerships with other players. I'd be glad to talk more. And I don't even know the time right now, but I know that I would like to leave room for Michael to come up, and we can join in some other conversations later. So we've got before I shift off, there's my information. what I think there's a ripe territory is bringing together that perspective with those who see a pathway and say, well, this is where we're looking. To me is a sort of chicken egg aspect coming up is how many foundations get this and want to do more than just deploy grants for, say, system transformation, but maybe towards custom cash flow analysis, business development services. How many of those foundations want to play there? And then how many investors recognize that there's others in the space that want to help and have different positions in the stack that will come in? And the more that we start just figuring out who wants to talk, we can start developing. From a foundation perspective, they're by law driven by the mission. So yes, we can do technical assistance along the mission of our enterprise. That's how foundations can deploy. I think that happens all the time, right? I mean, in my personal take is that people are investing either, and I've run into this, with some individual investors, they say, I don't expect to make money, I like what they do. So even knowing what they're trying to do, they don't think they're gonna make it, but they're still gonna invest, right? So if we don't understand the full outcome, I mean, if we can only, as a bigger institution, it gets harder as you get bigger institutions where they have performance metrics and reporting requirements and probably guaranteed minimums. You have to make this much. Whatever you do after that's fine. So they're in a tighter box. This is all I can do until the pathway is proven about that I can engage. Then in the idea of a mission-aligned value chain play with that you're not quite sure where it goes. Until that proves out, we can't engage. I know I've seen that. The other aspect is, are you willing to change your definition of risk? Glad to hear it. Yeah, it reminds me, I was asked to go down to Santa Barbara County because I had connections down there to talk to the community foundation that was trying impact investing. I was just flipping through my slides before it started, and some guy didn't recognize it. They said, oh, I'm sorry. He said, oh, no, these are the first slides I've recognized in all of these meetings here, because he comes from the investor world. So this is just a really ripe time. I haven't heard the term aligned intermediaries. I like it, it makes sense. I'd say CDFIs are in there because, so from an individual investor, I do direct investing and I have some funds that I deal with and I got managers, but the other side is dealing with, say, from a foundation, they're not gonna do $10, $20, $50,000 drops. They've gotta look at, say, $250,000 at a time. You got account management aspects, so where are the intermediaries for foundations who wanna do investing? CDFIs are a great spot. Someone like Crosby, yeah, this is it's the right time to be figuring this middle space out. The more we bridge it, the better it is. You had a great question. It's hard to say this is the behavior of consumers. I'm not going there, but generally speaking, demand for sustainable products outstrips supply. See that Super Bowl ads I mentioned? These big guys have done their work. They figure they're going to spend I don't even know what $1 million for those 20-second ads. They're going to talk about the impact. So the consumer demand is there. The willingness to pay, some of these products that we're highlighting will be higher price. It's understanding the higher costs and the benefits you get back. Right now, I would say that's not at the breakout stage for gaining, say, 30% of the market, but anything like early adopters, you need those early folks who are willing to pay that additional money coming in early to prove the market to grow. So some of these products that I listed up there, like grass-fed beef, you can only see in farmer markets. The feedlots are beginning to figure out how to do this. They're seeing some of it shift away. So bit by bit, it goes from the early adopters into larger consumer categories. Does the price drop? Let's hope. Whole nother conversation about, are we using the right cost function? Right here, how do we take our learnings with an established nonprofit through grants that are engagement? How do we use that to get others involved? I'm standing here. Right, that's one part. The other is lean in, and then so for us, we're on food. What we're food financing. So my constant headache is: are the groups that are still showing up here because they're interested in food or financing? And the answer I've heard forever is yes. So through food, our focus with everybody gets food, we can move through the system, understand new strategies. Those strategies that I'm talking about here are not just food issues. These are structural issues that can be deployed in other sectors. So It's getting sharing the knowledge. I've got a few case studies about how we got here. I'd be glad to hand some out. We are a project of Philanthropy Northwest, the Cascadia Food Shed Financing Project. So talk with Philanthropy Northwest as well. Be glad to tell you more about them. And just get the word out. That's really it. But what's great is that I'm finding we're not here alone. That graph, others are looking at this too. It's a matter of how do we match up. Last question. Well, one of the aspects is that we've been doing this for 3 or 4 years, and I remember early on, about the second year, one of the key players said, you do realize that your reputation is on the line, as in, it's not going as we thought, was the warning, because we had tried deploying money and we couldn't. And I thought that's okay. As for who I am, I'm okay with high risk. But it also made me realize that by organizing the capital into a separate project, we can de-risk each of their entities because they're not putting their name. We're trying something new. We've de-risked it. And so tail end, now same player is saying, this takes time. Some of this stuff doesn't solve itself overnight. You know, if we're dealing with system change, you have to recognize that, one, you don't understand the system. Two, it's going to take time. And so we're not done. I can't say, and look at how we deployed our money and look at how it all ends up yet. I can tell you what we're doing, what we've done, and what we're doing now, and what we hope comes out of it, which is a better understanding that there is actually a demand for what the research said, and that we won't have to put more grant money in, we can just do investment money. I'm going to stop there and turn it over. Does that sound right? Thank you.